If you've ever been confused when watching stock market news, you've came to the right place. Let's look at the most common words used by investors. We go from simple words like stocks to bigger ones like management and expense ratio. By the end of the video, you will understand most investing terms. Subscribe, hit the bell, and leave a like for more investing videos. I make these every day. This video is a preview of my stock market course, where I teach you everything about the markets, including over 24 never before seen videos from me. These are all animated whiteboard videos like this one, making learning about investing fun. Check it out in the description or comments below. Let's start with very simple terms. What is a stock or share? A stock is a share of a company. Owning a stock means you own a very tiny portion of that company. A share is another word for stock. You can say you own one Apple stock or one share of Apple. This means you own a very small piece of Apple, out of 5 billion pieces in total. Outstanding shares. This is the total number of shares a company releases to investors. Apple has 5 billion shares in total. Market capitalization. This is the total worth of a public company, calculated by multiplying the stock's price, which is the cost of one share, by the total number of stocks. If Apple stock was $200 a share, and they have 5 billion shares in total, we multiply 200 by 5, giving us a market cap of 1 trillion. This means all of Apple is worth $1 trillion. This number is much more important than a stock's price, which doesn't actually tell you anything about its worth. Bull markets. A period of time where the stock market is mostly going upwards. Think of how a bull attacks by bringing their horns up. You could also say bullish if you think a stock will go up. Bear markets. A period of time where the stock market is mostly going downwards. Think of how a bear attacks by going downwards on someone. You can also say you're bearish if you think a stock will go down. Long. You are invested in a stock for the long term. You think the stock will go up. For example, I could say I'm long on Apple stock. Shorts. You are a short seller of a stock. You think the stock will go down in the future. I can say I'm short on Apple stock. Volatility. The range of price movement is very high. One day a stock might go up a lot, the next day it drops a lot. This is usually higher risk. This can also apply to the whole markets. I can say the market is volatile for the year. Stock exchange. A place where stockbrokers and traders can trade stocks. The most popular exchange being the New York Stock Exchange and the Nasdaq in America. Each country has their own exchange. For example, the Toronto Stock Exchange for Canada. You don't have to go to the exchange to buy or sell stocks. A brokerage can work with you online. Trading hours. The hours where the market is open for trading. This is between 9:30 a.m. to 4 p.m. EST, Monday through Friday, closed during holidays. After hours trading. The hours where traders can buy and sell after markets are closed. This is between 4 a.m. to 8 p.m. EST, Monday through Friday, closed during the holidays. Some brokerages like Webull or Robinhood offer after hours trading. This is more volatile due to less traders being available, so your trades might not go through at your asking price. Ticker symbol. A small and unique symbol used to identify the company in the stock market. You can use the symbol to buy a stock in your brokerage. The symbol usually matches the stock's name, AAPL for Apple. Stock brokerage. A place to buy and sell stocks. This could be a bank or a company that does this for you. Robinhood, Webull, M1 Finance, and Fidelity are some examples of stock brokerages. There are free-to-trade brokerages like Robinhood and Webull, and traditional brokerages charge $5 to $10 a trade, like Fidelity. Signing up requires some personal information, like ID and income info. Buy, sell, or hold. Buy means the stock is a good buy, usually a recommendation by an analyst. Sell means the stock should be sold. The analyst thinks it will drop. Hold means the stock should be held if you own it, but don't buy it if you don't own it. Swing trading. Buying and holding a stock for 2 days to a few weeks before selling. Riskier than owning a stock for the long term. If you bought Apple stock and sold it 2 weeks after, that's a swing trade. Long-term trading. Buying and holding a stock for longer than a few months, usually for years. The safer form of investing in stocks. If you buy Apple stocks and hold it for 5 years, that's a long-term investment. Day trading. Buying and selling a stock in the same trading day. Extremely risky, even more so than swing trading. Buying and selling Apple stock in the same day is a day trade. Options. The highest risk way to buy contracts for stocks. Instead of buying the actual stock, you buy contracts that let you buy them at a certain price in the future. If you think Apple stock will reach $300 by next week, and it doesn't reach that price, you just lost all your money. Longer term options would be safer. If you buy a contract for Apple to reach $300 in 5 years, that's more likely to happen. Dividend. Money a company pays to investors for owning the stock. This is paid by profits and is paid every 3 months, sometimes monthly. A dividend of 10% a year means you get 10% of your money back every single year. Initial public offering, or IPO. When a company goes public, letting the general population buy shares of the company. Uber just had their IPO, so you can now buy and own Uber shares. You can't buy a stock of a company that isn't public, unless the private company wants investors. But this is not likely for the average person. Blue chip. A well-established and recognized company, with very stable finances. A big company like Apple or Walmart, they tend to be safer stocks to buy. Valuation ratio or metric. A comparison of numbers of a stock, used to value a company. A number like the profits earned is usually compared to the stock's price, giving us an idea of their value. The more of these metrics we learn and use, the better we can value a company. Due diligence. The research it takes to be confident in a company. This is homework for investments. This could be looking at valuation metrics, the news, or the history of a company. You need at least 2 hours of due diligence before investing in a stock. Index fund. A fund that tracks the market index, which is a combination of many stocks. An index can be stocks in the same sector, or just companies from the same country. An index is a good indicator of how a sector or a country's market is doing. Mutual fund. Funds that are usually sold and managed by banks. Actual fund managers pick stocks with their investors' money. Usually, mutual funds can beat the index fund, and they have higher fees, so you should avoid these. Management expense ratio, or MER. The fee it costs to own an index fund or mutual fund, taken from your investments every year. A 1% MER means your money will go down by 1% a year. $1,000 on a $100,000 investment. You want a lower management fee. Under 0.2% is good. Dow Jones, S&P 500, Nasdaq. Stock market indices, that's a combination of many stocks in one. These are used by the news and investors to see how the American market is doing as a whole. Each index has stocks like Apple, Microsoft, Walmart, Amazon, and other big companies inside them. The S&P 500 is the best indicator of how America is doing as a whole. Points, the dollar amount of a stock or index. If the news says the Dow Jones is down 300 points, the Dow Jones index is down $300. They use points instead of dollars because other countries don't use dollars. Bubble, an overinflated market that will likely pop soon, meaning go drastically down. This could be because stocks are overvalued or going up on fake news. Anything that keeps going up will go down sooner or later. It's called a bubble because bubbles pop. Volume, the number of stocks being traded in a certain time. Volume of 1 million means 1 million stocks moved hands that day. People bought and sold 1 million Apple stocks. Red or green. Red means the stock is going down or losing money. Green means the stock is going up or gaining money. You might say your portfolio is green today because it went up. Technical stock analysis. Analyzing a stock's possible future price based on reading charts and patterns in the price. This is extremely hard to do correctly. High risk. Stock price is not affected only by patterns, so there's only one small way to read stocks. Many traders use technical analysis, so the price is affected by this in a self-fulfilling prophecy. Emotional trading. Trading stocks based on emotions instead of strategy. This usually leads to losing money in the markets. A lack of emotion means better moves. You might sell Apple stock because you read some bad news about it. The right move is to ignore those emotions and think about why you bought in, which should be based on facts and belief in the company as a whole. CEO, Chief Executive Officer, the person in charge of the company. These guys run the company and make the biggest decisions. You want a good CEO because they will run the company well and increase the stock price. Board of Directors, the people in charge of choosing who the CEO and other managers are. They control a lot of the company's stocks, such as dividends and share repurchases. They don't control how the money is run, but how the stocks are doing. Margin, borrowing money to trade or invest with, usually with interest as cost. You might want to borrow $100,000 from your brokerage. They will charge you a fee per year, such as 3% on $100,000. This is extremely high risk and not recommended for beginners. Stock split, where a company splits the total number of shares to lower the price of a single share. If a company costs $100 a share and splits by 2, their shares will cost $50 a share. This does not change the value of a stock or company, it just makes it easier to buy single shares. This is why the price of a stock has no effect on the actual value of a company. Public company, a company that's available for purchase in the stock markets. A public company has to release their numbers in their earnings reports when going public. Private company, a company that's not available for purchase in the stock markets. A private company does not have to release any numbers. You can still buy shares of a private company, but it's more direct and more difficult. Average down, to keep buying a stock on its way down in price. This lowers your average price. For example, if you bought one share of Apple for $200 and you bought another share later, when it drops to $100, you have a price of $300 for 2 shares, or $150 per share average, giving you a lower average price. A basic strategy if you think a stock will rise back up. Record high. When a stock reaches a new high price it's never reached before. Apple just went up to $220, a new record high. You can also say a stock reached a 30-day high, or 52-week high for the yearly high. Rally, a rapid increase in price. An increase of 10% for Apple stock could be called a rally. Sector, a group of stocks in the same industry. Apple and Microsoft are in the technology sector, so they could be compared when valuing each stock.